Now, here's the truth. Most investors hit a brick wall, and it's not because they lack deals. If you're self-employed, if you get paid on a 1099 and you're reinvesting everything back into your business, this can create a lot of problems for you on your investment journey. The bank looks at you like a risk, and your debt to income ratio is a factor. Here's when DSCR loans crush conventional loans for your investment strategy. A DSCR stands for debt service coverage ratio, meaning lenders will care more about the property's ability to generate an income than they do about your ability to generate an income. Now you compare that to conventional loans, which rely on your W-2 income or tax returns, and oftentimes you're capped. Only up to a certain number of properties will this work. So let's talk today about a few of the differences between DSCR loans and conventional loans to see which route might be the best fit for you. So first, we'll talk about documentation. Now, I'm Jeremy. I'm a certified mortgage advisor based in Phoenix, Arizona. I'm an active real estate investor and a mortgage broker, and I specialize in empowering realtors, educating homeowners, and advising investors on how best to use mortgage financing to create the maximum amount of leverage for your investment goals to help create wealth long-term for you and your family. I appreciate you tuning in. If this is helpful, throw a like, and I look forward to connecting with you. So with documentation, conventional loans are going to require a lot of the things you might expect to submit to a lender so that they can verify your income. So these are things like pay stubs. Oftentimes we're going to look at 30 days history worth of pay stubs. We're going to look at your W-2s. And in many cases, we're also going to take a look at your tax returns. Now, documentation for a DSCR loan, very simple. We're going to need to submit a driver's license and a credit report, which we will pull for both conventional and for DSCR loans. And we're also going to do a rental analysis. And this is generated using a form called a 1007 form. It's a rental schedule addendum that an appraiser will complete at the time that they do your appraisal on your property to find the estimated opinion of value. And the cool thing about DSCR is even if the property is vacant, we can use market rent data to support the income coming into that property, which is the number one key for the lender to approve you or decline your loan. So documentation, as far as a DSCR loan, seems superior. The other part about conventional loans you should keep in mind is Fannie Mae and Freddie Mac, which are the two largest government-sponsored entities that purchase these loans from the market after they're closed, they're gonna have a limit on how many of these properties that you can actually finance. And there's no hard cap. You won't find that anywhere, but for the most part, you can finance up to 10 properties before Fannie Mae and Freddie Mac start to have a little bit of an issue approving you for future loans. They basically see you as high risk, right? If you have 12, 15, 20 mortgages out there, if something happens to you, if something happens to your ability to generate an income to pay those mortgages, well, that's a problem. So they're seeing that ahead of time and they're going to cap you. All right, let's talk about speed. So in terms of speed, a conventional loan will take anywhere from 30 to 45 days. There's a lot of factors here, but if it's a normal, straightforward loan, you can expect about 4 to 6 weeks for a closing. But for DSCR loans, and there's a little bit of a caveat here, they can take about 3 weeks. I say there's a caveat because a lot of this depends on the documentation that you have up front. If you have everything you need to provide up front for a DSCR loan, they can be quicker. But if we're spending 1 or 2 weeks at the beginning part of the loan, just gathering the right documents for you as an investor in order to approve you, well, that could take 4 weeks, 5 weeks, 6 weeks, just like a conventional loan. This is why it's important to get your documentation in order and also to work with an advisor that's going to give you a nice full list of exactly what you're going to need, not only to get initial approval, but to get to final approval and to get your loan closed quickly. Now we'll talk about LTV. Now, LTV is loan to value, and this is merely the calculation that you'll do to determine how much of the purchase price that you're going to finance. There's not much difference here. So conventional loan, you're going to be looking at 80% loan to value or 20% down. And then for a DSCR loan, you're also looking at the same figure, about 20% down. Now there are some differences. DSCR loans have some loan products that allow for 15% down. But the key factor here that you have to keep in mind, there's a couple things actually with 15% down. First is you have to make sure the property still creates cash flow. After you calculate your mortgage payment, your taxes, insurance, and HOA dues, if those are applicable, You want to make sure that that is covered by the expected rents coming into that property. Many times lenders will request a higher ratio, meaning they want to see even more cash flow out of a property where you're putting 15% down. So you have to keep that in mind. And for conventional loans, you don't need to submit a whole lot of documentation to support that rent, again, because it's approved based on your ability to generate an income, not the property. So if you put 20% down on a property that is a conventional investment loan, even if you have negative cash flow, you can still get approved. Again, because this is based on your income, not the properties. Now, something that investors do if there is a little bit of a discrepancy, a little bit of a negative cash flow between what your mortgage payment's going to be and what the expected rents are going to be, is they can put more money down. So if you need to put more than 15% down, for example, to get to 20% down, that's very common. You can even put more money down. You can put 25% down, let's say, to create a larger amount of cash flow every month. If you have enough capital to do so, that will bring your rate down more than likely, and it'll obviously bring down your mortgage payment every month. All right, let's talk about reserves. So reserves are simply the amount of monthly payments that you have on hand, whether that's through a checking account, a savings account, a retirement account, a CD, something that is, you don't have to liquidate it within seconds, but it has to be liquidated pretty quickly. So in other words, if you have equity on another property, let's say, you can't really use that for reserves. It's got to be substantiated with some documentation, usually an account statement, a monthly statement, or even a quarterly statement, for example, if you have a 401k, and that balance is what you're going to use for reserves. So with reserves for a conventional investment purchase, oftentimes you're going to be asked for 6 months of reserves. And that's to show the lender that if something happens, whether at the beginning of the loan, middle of the loan, whatever, that you have enough reserves on standby, and you're going to mitigate that risk a little bit by proving to the lender that you're a little bit more liquid. That's helpful. And then for investment loans, the number is going to be very similar. Now, we have lenders that show 3 months of reserves. We also have lenders that like 6 months, similar to the conventional side. And oftentimes investors that purchase on DSCR loans, they generally have a little bit more cash to show on that purchase, not just with their down payment and closing costs, but generally they're working other projects. They have other capital coming in by closing other deals, maybe selling a flip, or maybe they have another couple of accounts with other investment properties that show a little bit of cash on hand. So a lot of times those statements can be used to serve as reserves for the DSCR side. So all in all, the reserve requirement is similar, but I'd give the slight edge to DSCR. Here's another tidbit. With reserves, a lot of investors, what they'll do is they'll bring on private money lenders. So if they use, let's say they use me for their first lien position DSCR loan, okay? Sometimes they'll partner up with a private money lender to come in with the down payment, to come in with the closing costs. Maybe they'll come in also with some holding costs while they get into the property and fix it up and get it rented. A lot of times private money lenders will come on board and serve that purpose for investors. And a lot of times, some of these lenders on the DSCR side, they just want to see that those reserves have been located and sourced and seasoned, meaning they've been sitting in an account without being active and going from account to account for about 30 days. So that gives you a little bit of flexibility as an investor. If you bring in a private partner, and that private partner is not going to be part of that deal with you, whether they're an equity partner or whether they're just a private lender, they can use those reserves to support what your requirement would be at closing for a DSCR loan, which is a very cool feature. All right, interest rates. This is the big one. So interest rates for a conventional investment purchase. For the past several years, we've seen a big discrepancy between what a DSCR rate would be and a conventional rate. And we would see differences about a third of a point, half of a point, even up to a full interest rate point higher for a DSCR loan compared to a conventional. That's kind of shifted a little bit. And some of the reasons I think that is, there's a lot more mortgage loan originations happening in the country now that are investor loans. So if the investment loans are making up a larger percentage of the overall loan originations, lenders want to make money. Lenders want to offer a product that the borrower is going to use. And if there's a lot of investors out there creating these DSCR loan profiles, they're going to make that as attractive as they can. Now, it doesn't mean that these rates are lower than conventional right now. I just think they're super competitive. So, and as an example, if there's a conventional rate for an investment property that's hanging out in maybe the mid sixes today, give or take, it's pretty reasonable to find a DSCR loan with similar loan to value, similar loan amounts and percentages as a conventional loan, where you're only seeing a jump in rate of about 1/4 of a point, maybe up to 1/2 of a point, depending on things like credit profile, borrower experience, the amount of reserves that you have, and the location, the region of the DSCR loan. So what used to be a larger gap for interest rates has kind of slimmed down a little bit. It's gotten a lot more competitive for our investors with the DSCR loan product. Right, another factor here to consider is prepayment penalties. Now this is where there's a little bit of a difference. So for conventional loans, both Fannie Mae and Freddie Mac, they are not going to require a prepayment penalty, meaning if you got a loan today, and we're talking right now in August of 2025, and let's say by the end of the year, plans changed. You have to shift focus and shift tactics a little bit, and you needed to sell this property in the next 4 or 5 months. Let's say you needed to sell it by the end of the year in 2025. Well, you could do that. And there's not going to be an additional fee attached to paying off that loan early because there are no prepayment penalties for a conventional loan. Now, DSCR loans, on the other hand, offer prepayment penalties, but they also offer you the ability to remove that prepayment penalty if you chose to. The difference is the more prepayment penalty time that you opt in for when you do a DSCR loan, the lower the interest rate is going to be. The lender is going to make money on your loan the longer that you hold on to it. So the thought is if you close a DSCR loan today and you give yourself a 5-year prepayment penalty, most lenders go up to 5 years. That's going to give you the lowest interest rate possible because you're agreeing to say, hey, I'm going to have this loan for 5 years or more. And if I pay it off ahead of time, Mr. and Miss Lender, I will pay you a fee for that ability to pay off the loan. That fee can be anything like a percentage based fee on the unpaid loan amount. So if you agree to a 5-year prepayment penalty, that could be 5% of the outstanding loan balance that you would pay when you refinance or sell within that 5 years in order to pay off that loan. That's a big chunk of money. So if you have a $200,000 DSCR loan and you wanted to pay that off in year 3, but you've got 2 more years before your prepayment expires, that could be an extra prepayment penalty at closing of $10,000. That's a huge chunk of money. So you have to account for that. And it's also important that your mortgage advisor, when you're going through this process, that they lay out those options for you, knowing how much your prepayment penalty is, exactly how much time you have in order for that prepayment penalty to fall off, and also what the dollar amount of that penalty is, whether it's a percentage based, whether it's a flat fee. Sometimes you'll get a degraduating penalty where in year 1 you might pay 5% of the loan as a penalty on the unpaid loan balance, but in year 2 maybe that's only 4%. In year 3 maybe it's 3%, year 4 it could be 2%, then year 5 it'll be 1%, and then after year 5 now you're free and clear and you have no penalty that you have to pay at closing. Overall, with regard to penalties, I feel like the conventional loan is obviously superior. It is one of the negatives with the DSCR loan in order to get the best rates, but it is a factor. It is a variable. You just have to put that into your spreadsheet, make sure you account for that in terms of what you're going to owe if you do pay off that loan. So a quick case study here. If you're looking at a loan for an investment property, and let's say that your purchase price is $200,000, and you go with a $200,000 conventional loan. Now, what are the things you're going to need to supply to the lender? You're going to need to supply your pay stubs. You're going to need to supply your bank statements, at least a couple of months of bank statements, and then additionally, whatever account you're going to use to bring your down payment and closing costs, we're going to need to source that information as well and source those funds. And oftentimes with an investment loan, depending on how you generate an income, you might need to also supply your tax returns. This is where we start running into problems for a lot of business owners and entrepreneurs. Depending on how you set up your taxes and how many business expenses you might write off in order to protect some of the tax exposure you might have as a business owner or entrepreneur, those tax returns can show significantly less in income at the end of the year than your pay stubs or your bank statements might show. So we could run into an issue just with that step alone. Additionally, now your debt to income ratio might be affected depending on how many mortgages you have on credit, how many auto loans, revolving credit card, trade lines, and those sorts of things. Your debt to income is the other factor here. So it's not just looking at your income. They want to make sure of all the debts you have listed on your credit report that you have enough income to easily cover those debts and cover more debts. Now for a DSCR loan, for example, if you have a $200,000 DSCR purchase loan, well, we're going to look at 20% down. That's usually where we start, which is about $40,000 plus closing costs. And then we're going to look at the market rent for that property. Now, let's say the market rent comes in and it comes in great. Let's say this is a multi-unit. Let's say it's 3 or 4 units that you have here, and you're bringing in about $4,500 in rents. Your payment's going to be in that mid to low $2,000 a month range. So you have extremely strong cash flow. And this is an example of a property that we're currently working right now in Michigan. Well, we'll get an approval as long as your credit score is above 720. And a lot of cases we can go down to 680, but 720 is where the rate and the terms look more appealing. So we've got no W-2 needed. We've got no tax returns needed. We don't need to see any pay stubs. Again, we really just need a driver's license. We need a bank statement or retirement statement to show where your down payment funds are coming from. We'll need an appraisal along with a market rent schedule, which is the 1007 addendum in the appraisal that shows the market rent. And as long as the expected monthly payment is lower than what your expected income is going to be on that market rent, we're approved. Much, much easier this way. So in terms of the decision between conventional loans and DSCR loans, if you've got tight leases, if you have a lease in place, or there's leases in place from the property that you're purchasing, and those leases support a high rental rate compared to what your mortgage payment's going to be, you're good to go on the DSCR side. Now, where conventional shines here is if you are house hacking, for example, which is you're going to buy a home with a conventional loan. And let's say instead of putting 20% down, you're going to house hack, which means you're going to move into the property. That'd be considered a primary purchase. Now, the benefit here is that your down payment requirement goes way down. It goes down from 20% all the way down to maybe 5% at a minimum, which creates a lot better of an entry fee situation for you. You don't have to use as much cash. Now, conventional loans, your payment's going to be higher because you're only putting 5% down. You're not putting 20% down. So you have to factor that part in. Then you also have to have a decent exit plan here. You're going to house hack, so you're going to move in at closing. It is going to be your primary. That's part of the requirement there. Are you going to fix it up right at the beginning for a few months? Or are you going to take a year or maybe 2 years to fix up things in sort of a casual timeline fashion where you're going to give yourself some time to get the floors done, maybe do the floors in paint right when you move in, because it's much easier to do that, trust me. And then you start going through and doing some things with the electrical and plumbing, and you update the roof and you do your HVAC equipment, and maybe you get an appliance package and update some windows, all the cool things that we can do over time. And then after that 1 or 2 year period, well, then you turn that house into a rental. You make sure that your market rents surpass what your mortgage payment is, and then you can look around for your next house hack. So if you're looking at DSCR versus conventional and you're looking at the house hack strategy, conventional might be superior. The rate's going to be comparable and oftentimes better than a DSCR loan, at least right now. Your entry fee, the down payment you're going to be required to come up with, is going to be less. And your credit profile is going to be such where you don't have a lot of trade lines. You don't have a lot of mortgage financing products on your credit report, which means if you have your W-2s and your pay stubs and your tax returns and your bank statements and all those things, and you don't have a lot of debt on credit, this would be a great way to get into those first few investment properties. Turn those properties around, get them leased out, and then repeat that process down the road. That's huge. And it's important to note here, if you're going to continue down the house hack path, when you rent out a property, you can offset the mortgage liability on your credit by using an executed lease. Now, the hitch is, what a lot of investors don't know is you cannot use the entire amount of that monthly lease payment to offset your mortgage payment on your credit. Fannie and Freddie both like to see 75% of the incoming monthly rent to be used toward your mortgage debt. So as a quick example, if you have a market rent coming in of $2,000 every month on a property, and you want to go to get another property to house hack, you can use that lease to offset $1,500 per month off of your current mortgage trade line. It's important to note because a lot of times, depending on how much cash flow you have, you might have a little bit of negative cash flow on that property, even though you have a lease, and even though you have a lease that surpasses what that payment is. So you have to keep that in mind and do that math if you go the house hack route. So which of these paths is right for you? Well, that depends. Choose a DSCR loan if you're looking to scale quickly. If you're not looking to wait around for a couple years going the house hack route and you don't have a lot of mortgages on your credit already, conventional might be superior here, but DSCR is great for scaling quickly. If you're 1099, if you're self-employed, if you're a business owner or entrepreneur, and your income is wild and variable, DSCR would be a strong option. Now, if you have strong leases and strong cash flow, DSCR looks really good as well because you can use some of your experience, some of your existing portfolio data to support your experience, which oftentimes gives you a slightly better rate and slightly better loan product because you're showing that experience to the lender, and you can show them, hey, you've been around the block before, you know how this works. And if speed and flexibility is one of your goals, again, as long as you're prepared for the loan process and you have all documentation in place, DSCR can be a faster loan process, oftentimes 3 weeks. Now, where you want to choose conventional is if you are house hacking and you don't have a lot of mortgage items on your credit, check out house hacking, run the numbers for this route, and also run the numbers when you exit that house hack to make sure that the market rents at that time can cover a large chunk of that mortgage payment and then beyond, so that you're not left with a little negative cash flow that you have to absorb for the next house hack purchase down the road. Lowest possible interest rate generally comes with a conventional investment loan purchase. Now, DSCR is close, but conventional oftentimes is superior. If you're going to house hack, or if you're going to live in the property, let's say, conventional route might work better, especially if you don't have a lot of mortgages outstanding on your credit. And if you're going to hold long term, either route is going to be good, conventional or DSCR. And as far as prepayment penalty goes, you will have them with a DSCR loan. You can opt out of them by increasing the rate, and there are loan products available that allow for that. But with conventional loans, you will not have a prepayment penalty, so you don't have to worry about that cost. So make sure to factor these routes into your underwriting up front to see which of these paths is a good fit for you. All right, are you ready to run the numbers on your next deal? I hope so. Now, I have a free investment financing tool. This is a calculator. It includes fix and flip calculations. It includes a mortgage amortization schedule, so you can drop in your expected loan amount and a rough idea on an interest rate to get an idea what your payment's going to look like. You can enter in taxes, insurance, property management, HOA dues. You can plug all this into your spreadsheet and come up with your numbers. I included a small window for wholesale and assignment fees, so you can kind of reverse engineer what the acquisition should look like to make sure the deal you're getting is actually a decent deal. And additionally, I created a section for long-term holds where you can plug in all of your numbers for your initial investment to determine what your cash-on-cash return is every year by including all of your different types of debts and your credits monthly. And this is just a great tool to help figure out these numbers. What oftentimes I find is when you do the numbers up front before the deal, oftentimes, matter of fact, all the time in my case, those numbers are going to shift a little bit. Hopefully they're going to shift to your favor. Sometimes they shift the other direction. So you want to keep track of these things as you go so you can make better, more informed decisions month in and month out with your investment portfolio. I created this just for you. And if you'd like a copy of this spreadsheet, please send me a comment. Please subscribe. I'll get you a copy. And if there's anything else I can do for you with your next investment purchase, whether DSCR or conventional, let me know. Check out the Calendly link below. I'd be happy to have a conversation with you about your goals, see how I can best help. I want you to win. Hey, thanks so much for tuning in. Really appreciate you being here. If you like this video, if it was helpful and valuable, please drop a like and a comment below. I'd love to hear your experiences dealing with conventional loans and DSCR loans. And additionally, subscribe. My goal is to put out investment content, wealth creation content, and hopefully informative videos each week. And I like interacting with you guys. I like answering your questions. I'd like to hear more about what you're dealing with your DSCR and conventional loans today. Thanks again for tuning in, and I'll see you in the next video.